Here we come to the second part of chapter 10. So all those numbers and colors that we had before, that was the ledger. This is the journal. Now normally you do the journal and then you do the ledger, but to show you how all these things related to each other and why we had to make all these interesting entries the way we did, I really wanted to start with the ledger and show you why we had to do all those things. And so now I'm trying to show you, what we're really going to do when we go to the journal. So in theory, you should do this first and then move to the ledger, but you can move from the ledger and then put these into the journal if you want. For closing, it doesn't seem to matter, all right? And hopefully you have an understanding now of why we're going to do what we're doing. So the journal entries for closing are going to look like this. They're much simpler. So you've got your revenue account up here, and you're going to put in 2,650. Now this is all on page 260. The ledger accounts was on 261, but we're going to have this revenue account of 2,650, and it's going to go in the debit. Now you say to yourself, revenues don't go in the debit, Mr. Haight. Yes, and so that's why I did the ledger first. I wanted to show you the reason we're putting a 2,650 into the revenue account as a debit is to zero out the revenue account. It's to take that account that's 2,650 in the credit side, and we're going to put a debit in so that we can zero out that ledger account. So that means in our journal entry has to be that additional zeroing out number. So we would do 2,650 in the debit, and that'll zero out our ledger for revenue for this temporary account. Now the second entry, of course, is going to go into income summary. Okay? So that's why I did the ledger first, to show you why we're doing something you would never do. You wouldn't put a number in the debit for revenue because its natural balance is credit. But in this one case, we're going to put it in here so that we zero out the ledger account, and then the second entry has to go into something called income summary. All right? We do the same thing with expenses. Normally expenses are debits, but in this case, we're zeroing it out. Whatever it is, we're going to zero out expenses, and that is going to be 1,500. Now there might be a whole bunch of expense accounts, and we zero all of them out. And we can do that individually here. We can list them all, or we can just compile them into one and call it expenses, and we put the total, and to save board space, that's what I'm doing. Okay? And then, of course, the second entry goes to income summary. So on those ledgers we saw last time, you should see these numbers going into income summary, and that's where they come from. These are journal entries to zero those temporary accounts down. We're going to take them down to zero, and then the second entry has to go to something called income summary. All right? Now, if you remember, we've got numbers left over in the income summary, expenses and revenue, and we're going to close the income summary accounts to capital. So in the ledger, when we total income summary, if you remember what we did last time is we took the revenue ended up in there, and the income summary from expenses ended up in there, and we took the greater number and subtracted the lesser number, and we came up with our income summary. And in this case, we got an income summary that's on the credit side. So then we have to zero income summary out, and what we do there is we do the opposite of the credit. We had an income summary, it's a debit, and there it is over there. And then when we cancel that out to capital, it goes into capital as a credit, and that'll make capital go up. So that's why we had to do that, crossover and crossover kind of thing, because we're doing a double entry. We're doing a double entry close to income summary. We're doing a double entry from income summary to capital, and that's how we end up closing it to capital. And in this case, because revenue was greater than expenses, we ended up, through all those mechanics, we get a debit, we get a credit in the capital, and that makes capital go up. Okay? I know. That could be confusing, but the opposite could be true. What if revenue was the smaller number and expenses was the greater number? Then our income summary would have had a debit, in which case, to cancel it out, we would have had a credit, which means we would have had a debit going into capital, which would have lowered our capital. Okay? So depending on the size difference between revenue and expenses in the ledger will determine how much you get here. So we're going to practice this, because I bet I lost you somewhere along there. All right? But understand that we're closing revenue to income summary. We're closing expenses to income summary. Then we're closing income summary to capital. That's our third step. And finally, our fourth step, we close withdrawals to capital. Okay? And because of withdrawals position there and what it is, when we close withdrawals, we end up with a credit to cancel out withdrawals. So when the withdrawal account is at 500, we want to cancel it to 0. Normally it's a debit. We have to cancel it with a credit. So our second entry is going to be a debit. And that's what gets closed to capital. And that makes sense because a debit always reduces capital. Capital is reduced by a debit. So through this mechanism, we end up with a debit. And that reduces capital because that's what withdrawals does. All right? Okay, so I think we got harder, and then this chapter, the complexity went up by a lot. So there's a lot of crossing factors here with this double entry system that you have to keep track of. So you really want to keep your book open, especially page 260 and 261. That's going to be your guide for the journal and for the ledger. We're going to walk through these problems as we do this, and hopefully we can get a handle on it. All right? See you in class.